Bom dia a todos. O trânsito está muito ruim, então muitos vão estar chegando durante o evento, né? E o que eu vou fazer antes da apresentação do Marc é falar um pouquinho sobre ele. A primeira coisa não é a surpresa. O Marc, como todo holandês e como todo brasileiro, gosta muito de futebol. Em época de Copa do Mundo, esse já foi um assunto importante antes. Agora, passando para o lado sério, para o lado profissional, na realidade, nós estamos falando de um grande especialista do escritório da McKinsey em Amsterdã, e é uma personagem líder da parte de Corporate Finance, para principalmente a área do Benelux, Holanda, Bélgica e Luxemburgo. O Marc começou a sua carreira acadêmica com um PhD na Erasmus, uma universidade baseada na Holanda, e foi também oficial da Marinha Holandesa. E antes de se juntar à McKinsey, o que ocorreu em 96, Marc já era um professor assistente no Departamento de Finanças da Universidade de Erasmus, em Roterdã. Eu acho que um aspecto muito importante é essa carreira muito sólida, né, do ponto de vista acadêmico e do ponto de vista profissional, né? E ele, do ponto de vista profissional, se especializou em estratégia corporativa e valuation. E valuation é um tema básico que vai ser apresentado hoje. Ele tem uma imensa experiência internacional, principalmente Europa, e, basicamente, ele vai cobrir um pouco do que a gente chama value-based valuation e capital structure. O Marc trabalhou intensamente com um grande número de clientes na Europa, na área farmacêutica, na área de bens de consumo, energia e transporte. Ele é coautor de um livro sobre Valuation of Companies, Measuring and Managing, e escreveu o livro juntamente com Kohler e Wessels. E esse livro foi publicado na sua 6ª edição em 2015 e está, em breve, tendo a sua 7ª edição. Ele é um membro do conselho editorial do jornal da McKinsey, é um jornal trimestral, e tanto o livro como a revista são intensamente lidos, né? E ele é um contribuinte frequente para cursos acadêmicos em finanças em várias instituições da Europa. E eu tenho o privilégio agora de apresentar para vocês o Marc, que vai nos fazer essa palestra. Obrigado.
Very good. Well, thank you very much for such a generous introduction. My name is Marc Goedhart. I'm very happy to be here in Sao Paulo at this big event. And over the next 30 minutes, what I'd like to take you through is some of our latest thinking on how to actually create shareholder value in companies. And then also share some thoughts on how to best communicate that value creation to shareholders. As you heard in the introduction, I'm one of the authors of the book Valuation that you see behind me. It's now in its 6th edition. We're actually working on the 7th edition that should be out in 2020. And a lot of what I'm going to talk about is actually from this book and some elements that we'll include in the new book. So any thoughts that you'll have or questions, please share them with me, because we'll be happy to accommodate that in the next edition if possible. So 3 topics, basically. As you heard, I'm a professor, so I have to talk a bit about fundamentals, and I'll do that in the first section, the fundamentals of what drives shareholder value. Second, some new research that we have found on what drives shareholder value, especially in the long term. And the third, on what that could mean for investor communications, and sharing some thoughts on what I've seen happening, at least in European capital markets, as new developments in investor communication. So let's start with the fundamentals on how do you create value in a company. How do you actually make sure that the share price for your shareholders will increase, continuing to increase over the long term? And you can do that in a very complex way with big models, all kinds of different metrics. But what we actually found out over the years, and there's mathematical proof for it as well, is that it's much simpler than that. It's essentially two things that drive shareholder value. It is, as many people already know, is growth, but there's also return on capital, and both drive value. So as an example, where you see there on the screen, it's on that side, right? Two companies, Walgreens, which is a pharmacy chain in the US, retail chain, and General Mills, packaged consumer goods company, branded consumer goods. Had you invested $1 in each of these companies in '85, today that investment would be worth 14. That's the same thing, right? But the way these companies created that value is actually in very different ways. Walgreens, like a retailer, significant growth over that time frame, 20 times the amount of revenues today versus 1985. General Mills, much lower. But General Mills actually managed to create the same amount of value as Walgreens by actually having much higher returns on capital, around 20 to 30%, which is typical, at least in Europe and North America, for branded consumer goods. And Walgreens in retail, much lower returns. So it illustrates that it's these two elements that determine whether a company creates value or not. We can mathematically also prove, that's all in the book, let's not go there now, that it's actually the return on invested capital, so some measure of operating earnings over some measure of operating capital, earnings divided by capital, that's the return on invested capital, and growth. Together you can mathematically prove they drive cash flow. And as we all know, cash flow, if you discount that at the cost of capital, in the end determines the value of companies. But in this way, we can actually simplify that whole thinking around creating value in a company by just tracking what you do in strategic decisions, in day-to-day decisions, in terms of impact on these two dimensions, return on capital and growth. And you can make this a complex DCF model. This is a very simple model that we created based on these two elements, return on capital and growth. You can see on the vertical axis different levels of return on capital from 7, 9, 13, 25%, different levels of growth from 3 to 9% for the long term in a company, and what would be the resulting price-earnings ratio. So let's say the valuation level. And you can make a simple model that simulates this kind of value. The proof is in the book. But this is just to illustrate how thinking in terms of shareholder value along those two dimensions of return and growth will actually help you in understanding how to best bring value forward. Because both are important, but in different ways, right? And just to show that it kind of works, if we put in the long-term, last 50 years average return on capital for the S&P 500, which is around, let's say, 13 to 15%, and growth, which is around 5 to 6%, we get to a P multiple of 15 to 16, which is by and large what the S&P 500 has been oscillating around over the last 50 years. So simple as it is, it kind of works, right? Much more important is to see what it means for how, in a company, you should increase value, right? The first thing that you can see is that if you increase ROIC, in this case, right, from 9 to 25%, value increases always, right? Whether you have low growth, high growth, you can see the multiple goes, in this case, from 3 to 19. ROIC always increases value. Growth in a company does not always increase value. If the return on invested capital in a company, like in this example, is 9%, equal to the cost of capital, the WACC, actually value doesn't change, right? Because the return is the same as the cost of the capital. For industries where the return on capital is below the cost of capital, like 7%, below 9%, increasing growth would actually decrease the value. And it's only in the cases where the return on capital exceeds the cost of capital, like in this case at 13%, that value increases with additional growth. And actually, the value increase gets higher as the ROIC is higher for additional growth. And that's an important insight. I'll get back to that later. Just to show you that it's not just theory, it actually works, is if you do a very simple empirical analysis and you list for different sectors, the key sectors we listed here on this chart. You look at the valuation level of market enterprise value to the book value of capital, some kind of a market-to-book ratio on the vertical axis, and return on capital, you find a correlation of 90%. Right? Very strong correlation. Companies and sectors with high returns on capital actually do carry, very clearly, a higher value in the stock market. And if we do it for growth, we also find very strong correlation. Higher growth leads to higher value. In this case, we show it for a particular sector, right? Because you need to compare the growth for companies with similar returns on capital. So this fundamental thinking is not just theory, it's actually reflected in the everyday share prices of companies around the world. But there's more you can do with that very simple fundamental framework of values driven by return and growth. The first thing that it tells you, if you go back to that matrix, is that actually you can have the same multiple for different reasons. Many people, analysts, managers, investors, still take a valuation multiple like price earnings or EV over EBITDA as a proxy for future growth. But we now know there's more to it. If you compare the price-earnings ratio of Campbell's Soup in the US, which is a branded consumer company again, and Kohl's, which is a retail chain, same price-earnings ratio, but for very different reasons, right? You can have a high price-earnings ratio not just because of high growth, like in the case of Kohl's. You can also have a high multiple because growth is okay, but your returns are very good. So that's one takeaway, that even if you see different multiples of your company versus a competitor, it's not exclusively due to growth. It can also be due to differences in return on capital itself. And that's important when you're trying to communicate around value and value upside. The second thing that's important is that we know that if return on capital is low for a company, the best way to improve value is not by growing. The best way to improve value is by improving return on capital first. And that's what you see in, if I look in Europe across industries, commodity chemicals, airlines, the way they talk about strategy is not about growth, right? Everything they talk about in strategy actually goes back to return on capital. It's increased capacity utilization, it is cost control, it's increased utilization of seats on a plane, etc. So in low return on capital sectors, the best way to create value is to drive up the return on capital first. If you're in a sector or a company with high returns on capital, or businesses within the portfolio, high returns on capital, the best way forward for shareholder value is increased growth. And that's why you see high-tech or software companies, companies like Apple, or companies in pharmaceuticals where returns are high. If you read their strategies and their communication, it's much more about growth. Returns are already high. You still need to control cost. But at the end of the day, what makes or breaks returns for your shareholder is going to be about growth. And you see the same thing for consumer branded goods, the Unilevers, the Nestlés of this world, that a lot of their strategy is about path to grow, increased growth, etc. And you can all explain that, or at least understand that, from the finance fundamentals. So that's how, basically, it should work, right? And it sounds like it's very simple. You want to create higher returns for a shareholder, you need to focus on improving return on capital and or growth, depending on where your return is. But there's a bit more to it, right? It's not just about the trade-off between return and growth. There's also something like short-term and long-term. As a company, if I am in branded consumer goods, I'm a Unilever, a Nestlé, or a Coca-Cola, I can easily increase returns on capital for next year, right? I just cut down on promotion cost. That will definitely increase the return on capital for next year, right? It may not even hurt my revenues for next year, but it might and will start to hurt my revenues somewhere over the longer term if I keep my promotional activity and spending low. And it's very important for companies to find that balance between long-term and short-term and to avoid falling into the trap of just pushing for short-term performance, right? Even though it leads to an increase in return on capital and growth. Because the way it works, it needs to be for the long term. And what we found, for example, in research that was done, colleagues of mine last year, is that, interestingly enough, if you follow companies that consistently improve their margins, right, year on year on year, that companies that do that for 3 years, right, 51% of these companies still beats their industry in terms of TRS. Right? So companies that actually push their margins faster than their peers, upward, right, they do well in the short term. But as companies just keep pushing on margin improvement for 4 years, 5 years, or 6 years, actually they fall behind in TRS, right? And you can see that at some point, something like 55, 57% of companies actually have higher returns than these. And what this says actually is that, yes, it's about return on capital and growth, but it's about the long term. And if you keep on pushing on short-term success, like in this case, margin, where you cut back on overhead, you cut back on R&D, you cut back on promotional cost, just to keep on increasing your margin, at some point chances are that you're going to lose on revenues and you're going to lose on growth. And in the end, you're going to lose on value. That result was published last year by colleagues of mine in the Harvard Business Review. And essentially, what we figured out there is a piece of research that actually proves that companies that invest in the long term, that put their long-term corporate health as a high priority, that they also pay off higher returns for their shareholder value. So what we did there is actually look at the largest American companies. I think it was a pool of something like 600 companies, the S&P 500 plus a bit more. And we actually tried to classify the companies into companies that we thought, based on objective criteria, were more focused on short-term success or more focused on long-term success. I'm not going to go through all these indicators, but just to take out a couple of them, right? We would say, as number 3, companies that consistently, but over many, many years, improve margins, right? That alone is a signal that maybe they are too much focused on short-term success. Probably cutting down on R&D, probably investing less in innovation. Companies that, like number 4, that have an extreme track record of always hitting the next quarter EPS targets or the next quarter EPS consensus, that they're more likely to be companies that also go a long way with accruals, incidental gains, to meet these expectations. So companies that hit their EPS targets quarter by quarter for a very long time, that alone is also a signal that such companies may actually be overly focused on the short term. So we used a couple of these criteria to actually split up the sample in what we would call long-term and more short-term focused companies. And the interesting thing is that along many different dimensions, and here is just a selection of the outcomes, is that what we find is that those companies that are more long-term focused than short-term focused do better on many, many dimensions. On the left, we see growth, where the light blue line, I hope you can see the color difference, are what we call the long-term focused companies. Much higher growth, much higher revenues over that 15-year time frame. We looked over a long period of time, of course. And the top right-hand, also in terms of profit, and the bottom right, even in terms of job creation. These companies score better, right? And that gives another indication that, also based on the empirical evidence, right, companies that are not overly focused on the short term, hitting the next quarter earnings targets, hitting short-term profit targets, the companies that are more focused on the long term actually do better for shareholders as well. So it's an interesting case for shareholders that companies with a long-term focus, even though shareholders might be disappointed at the next quarterly earnings release, that if companies are doing things right for the long term, shareholders are better off as well. So for these companies, you can see on the left, it was 27% of the sample that we qualified as long-term focused companies, but they took 44% of the total shareholder returns created in the whole pool. So these companies clearly took a bigger cut out of the total value creation in the 600 companies. I think these 600 companies were something like 2/3 of the total US market capitalization. So focus on the long term clearly pays off. And it's completely in balance with essentially the first part, because when we're talking mathematically, right, or in finance terms about shareholder value, return on capital and growth, of course the return on capital and the growth that I showed, oh, you have an open bottle, thank you. They are there for the long term, right? It's not just the ROIC for next year, it's the ROIC for many, many years to come. And there are clearly companies that are better at managing their long-term health than others. Now, what does that mean then for investor communications? And what are some, what I think, parallels that you can see, at least with what I see happening in Europe, for investor communication? I think, and it's sometimes overlooked, and that's why I always try to emphasize that when I talk to clients about how to think about communicating to investors. If you think about the equity story, to have a very simple but very fundamental approach there as well, that every good equity story should have at least 3 elements. Something about the aspirations, what the company is aspiring to achieve over, let's say, the next 5 to 10 years, right? For example, if you're in retail, we want to become the #1 retailer in apparel in Europe. We want to grow by 7.5% our top line over the next 5 years. That would be the aspiration. And that needs to fit, of course, with the strategy that's being communicated. And the strategy is actually how you will achieve that, by rolling out new store formats of, let's say, experience stores based on what we know consumers want in our key markets in Germany and the Nordics, right? By doubling up on our online distribution channels, because we see there's huge demand for that. That would be the part of the strategy. And the third element, which I think is maybe the most critical of them all, is the evidence, right? Because in the end, shareholders will reward companies for what companies do, not for what companies say. So building up this track record of key achievements that actually underline how you are successful in that strategy and that make it more plausible that you'll be able to actually realize these aspirations, that's something that's sometimes overlooked. Yeah? And being very open, being very transparent and consistent about successes that you make, in this case, for example, in opening up these new experience stores. Come up in the investor presentations with the early successes of stores that were opened in certain cities and showing what the growth was in the sales per square foot, in the margins in these stores, and then returning to it every quarter, every half a year. Not just picking out the successes in an opportunistic way, but being very consistent about communicating these 3 elements, right? And being very consistent also in revisiting them every quarter, every half year, even when results are not good, is critical. And it links back to the fundamentals, right? Because essentially, what needs to be visible for investors across these 3 elements is how this will all affect value, and therefore, to make it a bit more concrete, return on capital and growth. And beneath return on capital, you could think of margin and capital efficiency and all the other stuff. And that return on capital and growth essentially has 2 sides, right? There's the short-term impact on return on capital and growth, which is typically the growth quarter on quarter in the different categories. If you're in retail, developments in earnings margins and particular profitabilities in particular categories, and capital efficiency, and that's what I would all call the short-term performance elements, right? It's the measurable quarter by quarter, year by year metrics that you can actually communicate on. But what is equally important, right, at least when I talk to let's say, the intrinsic, the fundamental investors, is how these aspirations, the strategy, the evidence actually links into what you would call the long-term health of the company. Because all investors will know that yes, you can be very successful in pushing growth in the short term by over-investing in new retail formats. You can, of course, improve your earnings margin by cutting down on promotion, cutting down on R&D. But in the end, they all know that value comes from the long term. And in the end, they all have this feeling, even if they haven't seen the research, right, that companies need to make sure that they also create the conditions for future return on capital and growth success. And then we're talking about the long-term health of the company. Is the company positioned strategically in the right markets, in the right products? Right? If you're now in automotive and you have essentially fossil-fueled vehicles only, you could wonder, am I strategically well positioned, right, to actually, especially in Europe and the US, to kind of live up to the new demands that will be put on automotive producers over the next decade, and the new challenges. How about my organizational health, right? Am I still attracting the right level of talent? You know, are my employees happy? Are they productive? Right? And that goes beyond just the pay level. And there are several ways to measure that organizational health, but it has to do essentially with the quality of the people and thereby the quality of the processes in the company. And then there are some elements that, as part of long-term health, at least in Europe, I see very massively on the rise. I think there's always been a discussion with investors in Europe about long-term health, right positioning. Are you attracting the best people? Are your operations up to levels of quality, whether it's safety or whether it's efficiency? But what has come along around the corner is essentially ESG, all the environmental, social, and governance elements that I also now see increasingly being blended into the investor story. I think it's a good thing, right? Even if you're not there to fight for saving the planet, right? I think these elements at some point also become important in saving the company, right? If you're an oil company, you might think you need to switch to renewable sources of energy for the good of the planet, but in the end, it's also in the interest of the business itself. And that's why these things, I believe, will actually play a bigger and bigger role. And it has been going on for quite some time in the US especially, right? I think if we look on the left, right, the amount of information that's being disclosed by US-listed companies has gone up massively over the last 5 years on these elements of environmental, social, and governance metrics. You know, we have different bodies of boards developing standards, now GRI and SESB. Maybe they will be cooperating, but there's a lot of activity there in coming up with meaningful, and I think that's the key challenge, with meaningful metrics and standards for ESG, but we'll see a lot more of it. And I think on the right-hand side, it's not just driven by idealistic groups of people who want to do good for society, save the planet, etc. I think on the right-hand side, we also see investors who are really interested in long-term value creation that are increasingly concerned about ESG matters. I'm sure you've all heard of the ExxonMobil case, where, of course, large shareholders, including even the larger institutional ones like BlackRock, put to vote that Exxon should disclose more about the impacts of climate change on its future business performance, right? So it's not an idealistic, it's a pure financial, value-based discussion. And Exxon will, because it was accepted in the shareholder meeting, will of course now be committed to disclose more about how climate change will affect its policy and its future business performance. Similar for Shell, also same thing. A couple of these ESG-driven groups that are buying up shares, bringing proposals into the AGM up for vote. Also for Shell to more aggressively pursue different strategies in response to requirements on emission standards and higher demand for renewables. And again, part of this is driven by idealistic motives, but I think what is now changing is increasingly we see investors also adopting these same kind of objectives and targets for pure value creation reasons. Because in the end, it's very important for the long-term health of the company and the business. Right? As another example, what I found in the research we did last year is that actually if you look on the right, that investments that are managed under some form of sustainable standards, which could be very far-fetching, like investors really trying to enforce, environmental standards within a company, to very mild, where investors actually upfront refrain from investing in certain types of businesses or sectors that don't meet their ESG standards, like some pension funds in Europe that no longer want to invest in fossil, let's say coal and gas-powered generators, let alone in coal mines. And that proportion has gone up enormously, right? It's now already at something like 26% of professionally managed assets worldwide. And maybe that will continue to increase. It doesn't mean everybody needs to be green. It does mean that we see that investors, and there are two examples, the left-hand side of the large Dutch pension fund and the government pension fund of Japan at the bottom. So I think together they make up $2,000 billion of assets under management that are also very explicit, very specific in what they want to see from companies in terms of delivering against these ESG standards, which I think from a value creation perspective would like to interpret as imposing standards that also say something about the long-term health of the company, in addition to the short-term financial performance that companies typically report on. And you already see companies responding to it. So at least in Europe, there are two examples, two Dutch companies at the bottom, right, where a company like Unilever is actually, in response to these concerns from investors, concerns from consumers, but ultimately, I would say also because of sound business reasons, have set up new types of brands, what they call sustainable living brands. Right? So brands like Dove, where actually you as a consumer, you can very easily trace, and you're guaranteed, that these products have been essentially manufactured with minimum waste, minimum use of resources, high energy efficiency, and of course also in all kinds of fair trade environments, so that the farmers from which the products are bought to the people who work in the factories are paid proper wages and work under proper circumstances. Now, you can think about that anything you like, right? I think interesting is we see companies adopting these strategies. There's a bit of idealism in there, of course. There's also a lot of sound business rationale in there. Because in the end, also these programs, as in the Unilever case, can lead to significant reductions in cost. They make a company more efficient. And I would argue they make a company more healthy for long-term value creation. And these disclosures, in some cases, this is Albert Heijn, as part of Ahold Delhaize, it's a Dutch-Belgian retail group. They become even very specific, right? And you can see them blended in. So this is not from ESG reporting, this is from analyst investor presentations of the company. Right? Where you can see they blend in within how well they do on operational metrics, these kind of environmental elements as well. Where they're very specific about how they actually reduce packaging cost, but also resource usage in the way they actually now present their products to the public. And being very specific on individual packaging, what the savings are in terms of switching from glass to recyclable plastics, even the trays on certain products, in terms of how many grams we have saved, but especially also the cost that in the end we are saving. So that's where it goes hand in hand. Trying to make a success about doing good for the environment, doing good for society, and also actually creating value for your shareholders by adopting a better business model. And that's where it actually comes around again. I think when I talk to clients about investor communications, I try to keep things as simple as possible, right? It's like, what do you need today to be successful in communicating the value that you are creating or expecting to create as a company? I think it starts, first of all, by understanding the share price of your company currently in the market, and what you believe the intrinsic value is, because the price and the value are not the same. Right? I think it's Warren Buffett who said, is price is what you pay, value is what you get. And understanding where that difference comes from, if you see a difference, a discrepancy between the price and the value you think the company is worth, understanding is it from a difference in what investors actually think I will do in terms of return on capital, and thereby margin and capital efficiency or CapEx, or is it from a difference in growth expectations amongst my investors versus what I think as a company that I can realize in my business plans? That's the starting point of all, right? And I think quite practically it means that in investor communications, someone needs to have a model, a valuation model of the company, to always be able to track between what we think the value of our company is and what apparently is the pricing today in the capital market, and be very explicit about what could be explaining any delta. Because that is an important lead in what to emphasize in the next investor presentation, investor dialogue. Right? Is it about growth or is it about margin? Because maybe I think it's all about growth and my investors think it's all about margin. Right? So that's the starting point, and that relates back to the fundamentals and understanding how return on capital and growth interact. The second is to focus on those investors who matter. Right? Lots of I think a lot of the communication that I see happening between European companies and investors actually happens with investors that at the end of the day may not make a big difference to the price of the company. They may be event-driven traders, they may be event-driven hedge funds who are essentially betting on whether the next quarter earnings will be better or worse than expected. Hedge funds that may be betting on whether you will do a share repurchase or not. And they may even take up a lot of time in the discussion. But the question is, does it matter for your share price? And we have other research, and we're going to show it now, so it actually leads to think that those investors, although they might matter for your price, actually are not going to do anything different based on what you communicate. Right? The hedge fund wants you to do a share repurchase, right? And whether you talk about long-term value creation is not on their agenda. And what you should focus on is those investors who are interested in the long term and who are interested in your strategy and who will be looking across the next quarterly earnings. That's the ones to tailor the communication to, right? And that's where you need to develop the support. That's where you can understand why, under the first bullet, there may be a difference between the price and the value that you think you should be worth. Third is articulate the equity story for long-term value creation. That's actually, I think, what we just talked about, how that goes from aspirations to strategy to evidence, and how now lately, more and more of these long-term health elements I see creeping into the stories, at least in Europe. The fourth, and that's especially, again, for Europe, at least in my experience, always be prepared for potential activist intervention. We've seen a lot of activist intervention, even in the Dutch market, as you've seen in the press, whether it's AkzoNobel, Unilever, or Shell, and being prepared for that. It all relates to the prior three elements, again, right? Because ultimately also these activist shareholders will want to see a higher share price. Maybe not in the way that you would like to realize it as a company, but ultimately it goes back to these fundamentals again. And fourth is raise, in some cases, I think still, the sense of accountability among managers, of the importance of talking to investors, and that the investors are the owner of the company and not the holders of a share. And to make sure that that management actually invests in their investor communication. That's the communication part, and it should all, I think, in the end, be driven by what we know fundamentally creates value. That, of course, is cash flow, but cash flow, we can mathematically prove, is actually driven by return on capital and growth. Not just in the short term, but in the long term. And that's what all the communications should be based on. Because that's ultimately what's going to translate into a higher or a lower share price. And in everything we communicate, I think it's important to be able to show how it's going to impact either returns and or growth. And whether that will happen in the short term or the long term, and being very explicit about that. And that's where it all comes together. As I said, some of these have been very long-standing principles, return on capital and growth. I think what is new that we recently found is that this long-term focus really pays off. Now we have the empirical evidence for it. And the third element is that investor communications, I think we see more and more of this emphasis on corporate health coming back, sometimes through an idealistic backdoor in the environmental and the social and the governance elements. But whether we like it or not, I think it's also going to impact business value going forward. And that's why companies should pay attention to it and also communicate around it. And that's my content to kick off your day today. I'm happy to entertain any questions or comments. I think it's going to be a microphone. And my time has expired. Yes, I was. Thank you. That's all good. So thank you for your attention, and I'm happy to entertain any questions.
No, thank you very much, Marc. Yeah, it has been a privilege to see your presentation. And your presentation brings a few words that are very important, especially for investor relations, Brazilian companies in general. But the expression long-term is a challenge in Brazil. You are living in uncertainty in economic, political scenario. And if you go back 10, 12 years, actually, it was very interesting. Companies were doing very well with IPOs.
Yes.
And one indicator like multiple on EBITDA of the future year was actually a key indicator and helped very successful IPOs. You don't have IPOs. So you brought the idea that long-term growth strategy is very important and how to link that to return on capital and value creation of the long term. So a lot of material for our companies and our investor relation people to communicate. Thank you very much.
You're welcome.
You have some time for questions.
Yes, please.
Nós temos algum tempo para perguntas, né? E o que eu comentei é que simplesmente a palavra long-term expression, né? Long-term health é muito importante, crescimento, retorno sobre capital e criação de valor a longo prazo, né? Então, eu deixo por conta das perguntas, né? Helmut.
Hi, Marc. My name is Helmut Bossert. I'm from MZ Group. Thank you for your so clear presentation for us here, for the audience. My question is more to try to understand what the market is thinking nowadays in this long-term value creation. Looking besides the ESG, what should the companies show to the market in terms of invisible assets? I think there's a lot of companies nowadays, technological companies, that the market should understand more what is behind the value creation of those companies through the capital reputation, the human reputation, and so on and so forth. And the final point is, how could we measure this?
Thank you. Thank you. And maybe to start with the last part of your question, how can we measure this? I think that really is the big challenge. And what I see, of course, is a lot of investors, analysts, and companies that are looking for, just as we have in accounting, for some kind of agreed upon metrics and standards that you can then report on, whether it's CO2 emissions, it may be pay ratio, right, which now at least in Europe is becoming commonplace. So the pay ratio is the ratio of the CEO salary versus the median salary in the company. And personally, I think, as I said, the global GRI and the SASB are also trying to set these standards. For me, it's important there will be some standards. I think it's even more important what's behind these standards and these metrics, because all the topics you mentioned and that we talked about, whether it's ESG, but also long-term strategic positioning, even organizational health, let alone management quality, they're very difficult to capture in standard metrics, right? There is no, let's call it operating profit equivalent even for CO2 emissions, right? Because even CO2 emissions, you have to be careful what you all count in, right? Will you also count in the leased equipment? Will you count in the outsourced production that is now taking place in Asia instead of Europe? But it's all on long-term contracts with you as an off-taker. So even for things that you would expect are clearly measurable, there's still a lot of debate on how to measure it. So I think in terms of value creation, it's more important what is behind it, because the metric and the standard is just a reflection of what we as a company try to achieve in the long term. Do we expect to grow because of technological innovation? Do we expect to grow because we are confident we can be a cost leader for many years? Do we expect to grow because actually we think the quality of our processes and our people is better? I think that's where it all starts, to have a very clear perspective on why you will win, right? Forget about finance, forget about capital markets. In the end, it's also about how to be successful at a business. How will you win from the competition, right? And starting from there, and you'll see that there's a lot more than ESG. I fully agree with you, right? There's a lot about strategic positioning. Am I in the sector? We know from long-term evidence, right, that what determines a company's growth rate most is the growth of the sector and the segments it's in, right? If you're in a low-growth sector, you can fight whatever you are, right? Whatever you can, you can increase market share, but at some point it stops, right? And what we see is what determines the growth rate of companies is the choice of the sectors they want to compete in. And that's not at the level of being, in automotive, but within automotive, is it electric, is it fossil fuel, is it hydrogen, etc.? Is it in the premium market, or is it in the lower segments? These choices, they determine the growth rate. And I think that's where it all starts with strategy, being very explicit about the choices you make as a company. And for some of these choices, it may be possible to come up with a certain metric. I don't think for the things that I mentioned as organizational health, very hard, but at least for making your choices about where you want to grow, you can be explicit about what you think the size of the revenue pool in that segment is going to be long term. What you think the long-term growth in that sector is, and that's why you want to play there. And I think we'll be a long way from standardizing all these metrics. So for me, the long-term health is more about the logic, right? The relation to strategy and success. And in certain elements of it, if you can prove it by showing metrics and standard quantitative outcomes, all the better.
Hi, Marc.
Uma pergunta ali, né? Sim.
Tamires from Votorantim. Thank you for your presentation. If you are in a meeting with an international investor, how should we start a conversation about ESG? Because we are always confused what they would hear about it. How can you start this kind of conversation?
As an investor or as a company? Just to make sure I understand.
As a company with investors.
As a company with investors.
Yes.
I've seen different ways. I've seen CEOs who actually started that conversation really from the conviction that as a company you need to do good for society and not create value for shareholders only. I've seen also CEOs that actually started that conversation from the conviction that being more prudent about what you do in terms of environmental impact, how you affect society, what the quality of your governance is, because they're fundamentally convinced that it will lead to a better company. Personally, I think that second is the more powerful line, because of course this is very noble, being a good steward of scarce resources, if you see this on a global level. But I think as a company, you're initially there to run a business. So I think those CEOs and those companies who can actually blend in these considerations as a core part of their strategy, like Unilever does in the sustainable brands, right? Essentially what they report on is not just that they now have brands where you can track where they come from, whether they've been produced in an environmental friendly way, whether it's on a fair trade basis, right? I think it makes it all the more powerful because they can also, and they do report, on what the financial results of these products are, and that they realize 40% growth year on year with these products in certain key markets, right? Because that's actually, for me as an investor, what would make it sustainable in the capital markets term, right? They're sustainable in ecological terms, but that can be a very expensive game and a very expensive trajectory. what makes it truly sustainable if you can marry these environmental considerations with sound business. Right? And there are a couple of examples there. And that depends on the sector you're in, the consumer pressure you will find. Sometimes it's just regulation, which is happening in Europe now on a large scale. The whole transition to renewable energy with climate agreements, etc. But I think the powerful way is if you can actually translate these ESG elements essentially to financial results in the long term. And that actually goes across the corporate health. Because in the end, I think if you don't have the conviction then that doing good for CO2 emissions, doing good for fair trade, doing good for society doesn't translate into long-term success of a business, I think that's the wrong direction. And this is the more difficult part. But we've seen examples of where this can be successful. And I think if you put yourself in the position of an oil and gas company, right, sitting on huge reserves of fossil energy, I mean, the question must come to mind, what are these reserves worth in 10 years? Will I ever explore or exploit all these reserves, especially in the sections within oil and gas where actually the environmental impact is heavier? So I would start maybe somewhere idealistically, but make sure you can translate it into long-term success of the business.